Okay, the third statement that we are discussing is the statement of cash flows. According to MFRS 107, cash flows are classified into operating activities, investing activities, and financing activities. The cash flow statement will show the cash inflows and outflows according to the three main types of activities: the operating activities, investing activities, and financing activities. What are cash flows from operating activities? They include cash received from sale of merchandise and rendering of services. Okay, so when the business runs their operation, whether they are making sale of merchandise or they give out services, any cash received from those operations will be included under the operating activities. And then cash received from royalty, fees, commissions, and other types of revenues will also be included in the operating activities. And then cash paid to suppliers as well as cash paid to employees, these will also be included in the operating activities. Next is cash flow from investing, and these include cash receipts from sales of property, plant, and equipment. As we know, property, plant, and equipment are purchased not for the purpose of getting profit, but for the purpose of running the business, and property, plant, and equipment is expected to give benefit to the company for several years. So the cash that we receive from the sale of property, plant, and equipment is not considered as an operating activity, but cash from investing activities. Next is cash payments to acquire property, plant, and equipment, intangibles, and other long assets. So when the company pays out cash to acquire these fixed assets, it is considered as an investing activity. And then cash payments to acquire equity or debt instruments of other entities and interest in joint ventures. So if a company invests money in other companies, in other equity capital or debt capital, so that is considered as part of investing activities. The third one is financing activities. That includes cash proceeds from issuing shares or other equity instruments, and from issuing debentures, loans, notes, bonds, mortgages, and other short-term or long-term borrowings. So when the company issues shares, they will receive money, cash from the investors. That is part of financing. So they issue shares to get financing for the company. And then cash payments to acquire or redeem entities' shares. So on the other hand, when the company buys back the shares that have been issued, then that is also part of financing activities, as well as cash repayments of amounts borrowed. Okay, in the top one, we see that when the company receives money from lending, so that is part of financing activity. To repay that loan is also a financing activity. There are two ways of reporting cash flow from operating activities inside this statement of cash flows. There's the direct method, and then there is the indirect method. So in the indirect method, for operating activities, the statement will show the major classes of gross cash receipts and gross cash payments. Okay, but in the indirect method, they will start from the profit and loss coming from the income statement, but then because the profit and loss is based on accrual accounting, whereas the statement of cash flow will show cash basis accounting. Therefore, it starts off with the profit and loss, but is adjusted. So it is adjusted for several things. One is from the effect of transactions of non-cash nature, for example, depreciation. As we know, to calculate profit or loss, any revenue will be deducted by expenses, and one of those expenses will be depreciation. But depreciation is not a cash transaction, therefore it must be adjusted back out of the profit in order to get back the net cash inflow. And then it will also be adjusted for any deferrals or accruals, okay, because some of the cash received is as a deferral for future transactions, and within the same year there are some accruals that have not been received in terms of cash. Therefore, those deferrals and accruals need to also be adjusted from the profit and loss in order to get the net cash flow from operating activities. And in the indirect method as well, the profit and loss needs to be adjusted for items of income or expense associated with investing or financing cash flows. Okay, so within the operating activities, we should not include those income or expense related to investing or financing. So take them out and put them inside the investing activities and financing activities. This is an example of statement of cash flows, and this uses the indirect method. So when you see, because it starts with the indirect method, the cash from operating activities will start at the profit before taxation, and then we make several adjustments. For example, allowance for impairment loss on investment in the subsidiary, allowance for impairment loss on associates, okay, amortization of concession assets. So several of these are non-cash transactions, like bad debts written off. These are not cash transactions. And then there's the items which are related to non-operating activities, rather financing activities such as finance costs. So all of these items are adjusted from the profit before tax to get the cash from or for operations. This is a continuance from the statement of cash flows that we see here, and this continues with the investing activities as well as the financing activities. So after we add the cash from operating activities with the cash from investing activities as well as cash from financing activities, we will get the net increase or decrease in cash and cash equivalents. This is an example of a direct method in preparation of the statement of cash flows. The direct method straight away shows the cash flows based on the three types of activities. So here is the cash from operating activities, and a little bit to the bottom of the cash flow statement will be the cash from investing activities as well as cash from financing activities. So we have mentioned earlier that some of the components of financial statements include notes to the accounts. Okay, so what do people put in the notes to the accounts? Firstly is the basis of the preparation of the statements. So the company will make a statement stating what basis in the preparation of the statement, and that basis will be mentioned in the notes to the accounts. Secondly, there will be statement on the compliance to MFRS. Thirdly, the company will mention all of the significant accounting policies that they apply in preparation of the statements. In the notes to the accounts, companies will also disclose information that is required by MFRS. For example, the details about items in statement. When MFRS requires them to disclose more detail about the items that appear in the statement, they would show it in the notes to the accounts. And then companies may also put other relevant information inside the notes to the accounts. So here is an example of notes to the financial statement. Here, this notes to the financial statement shows the main activities here. So here we have the general information of the company and then the principal activities. So the company is telling the users about the activities of the company by stating it inside the notes to the accounts. And then the company also describes the basis of preparation of the statement in this section. So here it says that the financial statement of the group are prepared under the historical cost convention and modified to include other bases of valuation as disclosed in other section under the significant accounting policies. And it also mentions the standards that the company has adopted in the preparation of the financial statements. It says here, during the current financial period, the group has adopted the following new accounting standards and interpretation. So they listed down the standards that the company adopted. So this is an example of the significant accounting policies that the company discloses inside its notes to the accounts. Here in the property, plant and equipment, the property, plant and equipment are stated at cost and revalued amount less accumulated depreciation and impairment. And it says how depreciation is calculated. It says here that depreciation is calculated under the straight line method to write off the depreciable amount. And here it shows the depreciation rates for all of the fixed assets. For example, 2% for building, 10 to 33% for office equipment, and so on. Here is another example how significant accounting policies is mentioned in the notes to the accounts. For example, here it says sale of goods, revenue is recognized upon delivery of goods. Okay, so it says how the company recognizes revenue. So it says here that revenue is recognized upon delivery of goods, whereas services revenue is recognized upon rendering of services. In the notes to the accounts, it is also used to give out more detail for items that appear in the statements. For example, inventories. Inventories in this financial statement will only be shown as a one-line item, but in the notes to the accounts, the company is able to disclose more information. It will show here that this company has 3 types of inventory: raw materials, work in progress, and finished goods. And it will show the cost of these inventory, and it will also show the net realizable value of the finished goods. Here is another detail that is being shown under the notes to the accounts. Here it is showing the share capital. What are the share capital consist of? It consists of the authorized ordinary shares, and it also consists of non-cumulative, irredeemable, convertible preference shares. Okay, and it even shows the par value of the shares, the market value of the shares, and it also shows the actual issued and full paid up capital. In this section of notes to the accounts, it shows the revenue in terms of how much revenue is obtained and how much is the cost of sales. So here the top part is the revenue, and the bottom part is the cost of sales, which include cost of inventories sold. Another example of how detailed information is shown in the notes to the accounts is the profit before tax. How is profit before tax is calculated is shown here. Okay, so it shows all of the items when coming up with the profit before tax, which includes amortization of concession assets, amortization of intellectual properties, there's the interest expense, and so on.